Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. President-elect Donald Trump vows to impose additional tariffs on China, Canada, and Mexico, saying they need to clamp down on migrants and illegal drugs. The dollar rises and Asian stocks drop on the prospects of Trump's additional 10% levy on Chinese goods and 25% on his regional neighbors. We have a great lineup of voices on how Trump's tariff plans could affect the global economy as well as markets. We'll hear from Minneapolis Fed President Neel Kashkari and co-director at the Center for Inclusive Trade and Development, Jennifer Hillman, joins us live, along with Bank of Singapore's Eli Lee. Plus, the U.S. charges against the Adani group are being shrugged off by Prime Minister Modi's coalition partners. We explore why it'll be tough to launch a formal investigation in India. Well, Trump is not president yet, but we are getting a good look at how things are going to be as he roils the markets once more with comments on social media. Trump says he will impose additional 10% tariffs on goods from China and 25% on all products from Mexico and Canada. He says the new levies are necessary to clamp down on migrants and illegal drugs flowing across U.S. borders. Trump's latest tariff threats are a sharp counter to hopes that he could temper his trade policies during a second term, and markets are not taking the news well. Avril Hong is here for a closer look at the reaction. Avril, hello, volatility, my old friend.
Yeah, it's a bit of deja vu, right? We've kind of seen this story before, and on the greenback, that's where the moves are the most pronounced, that reaction to those headlines out of Trump. And we're seeing the dollar resuming its upward march and hitting the Bloomberg dollar gauge at one point in the session, the highest level in 2 years. And this is a reversal from the declines yesterday when traders were reacting to Trump's pick for Treasury Secretary. And these gains you're seeing in the dollar come despite some of these dovish comments from Fed official Neel Kashkari. Let's flip the board. Take a look at the currencies of the U.S.'s top trading partners. They are getting hard hit today as traders react to these headlines. We saw the loonie at one point losing 1.4% against the greenback, not typical of the Canadian currency during Asia hours. And I think it speaks to the sense that it's not about Besant or the Fed. It's going to be about Trump for today, at least. For EM currencies, amid uncertainty about trade policy, one thing is for sure, we're going to see FX volatility. Now, it is worth noting that during the last Trump administration, we saw how, the currencies were the most hard hit. And this was also this China trade spat kind of coinciding with a time when the Fed was hiking. This time around, there's a lot of uncertainty about how countries individually are going to retaliate, potentially. But this is what we're seeing across the board. It's a sense of, that currency selling first and then ask questions later. That's showing up earlier in Chinese stocks in a way. It's really interesting how we saw declines on some of these gauges. This was related, of course, to the continued disappointment from stimulus, earnings, bracing for Trump, and China's gauges have actually pulled about 20% away from those October peaks. A bit of a reversal now. You're seeing maybe a bit of these China ETFs that receive attention from the home team getting a lot of love today.
That's right. Perhaps it's a case of being oversold. Avril Hong, thank you so much for that. For more on that Trump tariff news, let's bring in our Chief North Asia correspondent, Stephen Angle. Steve, here we go again.
Yeah, where do you want to start, Haslinda? Absolutely. I mean, we got roiled by the headlines. We're headline surfing here all morning, obviously, and the markets are obviously trading on these headlines coming across and across from Truth Social, that Donald Trump's platform, essentially in two very volatile comments, shaking things up. In particular, we all know, of course, that Trump has promised 60% tariffs across the board as soon as he becomes president again in January. But this is taking this a step or two forward in the sense that he's now vowing if China does not take further action to curb what he claims to be, the originator of fentanyl and the precursors to that drug through Mexico, he will slap on day one, January 20th, 2025, an additional 10%. And essentially, he says we will be charging China an additional 10% tariff above any additional tariffs. That's to clarify that, again, those 60% tariff increases that he promised on the campaign trail are still potentially in play, but come day one, it'll be 10%. Now, adding to the turmoil is that in a second message on his Truth Social platform, essentially saying he's also going to be taking on Mexico and Canada on the southern border and the northern border for not protecting against the drug inflows as well as illegal immigrants. 25% tariffs if those two countries do not respond adequately to the incoming president-elect. Now, we have heard already from the Deputy Prime Minister, Chrystia Freeland of Canada. We can bring up that quote as well, essentially saying, of course, reaffirming that Canada and the United States have one of the strongest and closest relationships, particularly when it comes to trade and border security. She goes on to say Canada is essential to U.S. domestic energy supply, and last year 60% of U.S. crude oil imports originated in Canada. And Haslinda, that's a key point because 57% of Canada's exports to the United States is three key components that could potentially disrupt supply chains as well as increase CPI inflation. That is energy, which was 60%, as Chrystia Freeland just said, but also autos and auto parts. The auto parts and the truck industries are very intertwined across the border between Detroit and Ottawa and other manufacturing places in eastern Canada, and also consumer goods. Those are the top three. So this opens up the front, the tariff front, not just China, but Canada and Mexico and China, the three top trading partners of the United States.
That's right. And we have learned that Canada has responded. Trudeau has had a conversation with Trump. You got to wonder how China is looking at it, Steve.
Yeah, China will not necessarily comment right away. We're still monitoring about whether there'll be the comments today from the foreign ministry in the regular briefing out of Beijing. But I'll guarantee you this, China is preparing for the specter of increased, what they call protectionism from the Trump administration. And again, that's sort of why the Chinese have held off from this next round of fiscal stimulus, because they're kind of weighing how far he will go with his promises. And we got the opening salvo right now, 2 months ahead of his inauguration. And again, the Chinese must, in their minds, shift to an emphasis on domestic consumption if those exports are going to be heavily, heavily tariffed.
Steve, thank you so much for that. Bloomberg's Chief North Asia correspondent, Stephen Angle, who undoubtedly will be really busy over the next 4 years. Well, I also discussed the impact of tariffs on the U.S. economy when I spoke earlier today with Minneapolis Fed President Neel Kashkari.
In terms of tariffs, ultimately, a one-time adjustment in tariffs would likely lead to a one-time change in the price level and not by itself lead to long-run increase in inflation. But it really depends on what our trading partners end up doing. And if there ends up being a tit for tat where economies continue to raise tariffs on one another, that can be much more inflationary. So we right now have to simply wait and see what the new administration decides to do. And then, of course, what other countries might do in response.
Wait and see, but we're getting some indication of what can be expected. We'll have more from that conversation ahead on the show. For now, though, let's get perspective on Trump's tariff pledges with Jennifer Hillman, co-director of the Center on Inclusive Trade and Development. She previously served on the World Trade Organization's appellate body and also at the U.S. International Trade Commission. Jennifer joins us from Washington. And with us here in the studio is Eli Lee, Chief Investment Strategist at Bank of Singapore. Jennifer, let's start with you. I mean, this is kind of like reminiscent of the renegotiation of NAFTA. It's just the start of it.
Yeah, it's hugely significant. I mean, when you think about it, a 25% tariff on our two largest trading partners. I mean, Mexico has now become the #1 trading partner with the United States, followed by Canada. And part of it is the markets are highly, highly integrated. Particularly, I would say the two sectors that have sort of already been touched on, autos and energy. I mean, autos is one of those industries where you're seeing some of the auto parts literally crossing the border 8 times before they ultimately get developed into a car. So when you start to then put a tariff on of 25% on each one of those parts each time it crosses the border until it ends up becoming developed into a car, you start to see how incredibly significant this idea of a 25% tariff on trade with Mexico and Canada. I mean, again, you think about it, that right now the trade between the three countries is now in the order of $2 trillion a year, $3 million per minute, accounting for 10 million jobs and at least 15% of global trade. So this idea of hitting our two largest trading partners, again, with this somewhat unusual notion of using tariffs, a trade tool, again, an economic trade tool, in order to fight something that is not particularly trade related, in the sense that, complaining about fentanyl or about, border crossings, migration issues, but yet using this tariff tool to do it is, again, a very out of the box. And again, from, many people's perspective, not an appropriate use of a tariff, and certainly not consistent with the commitments that we made. Yeah.
Is there a sense that it is the initial salvo? I mean, this is a businessman. He's a negotiator. It's a case of putting the numbers out there so that perhaps, his trading partners will come to the table and give a good deal.
Oh, absolutely. Yes. I think, again, you can expect this to be very, very transactional. And I think that's part of the reason for announcing it well before he's even in office. I mean, he is clearly looking for, and I would say, Canada and Mexico to come to him with offers of things that they can do. And I think you already heard a little bit of the flavor of what Canada is going to say, which is, why are you coming after me, Canada? With respect to fentanyl and with respect to migration issues. That's really not been the issue that the United States has seen is, again, a flood across the border coming across the Canadian border. And the issue is whether this is partly trying to divide Canada from Mexico and have them be treated differently. But there's no question that this is an opening salvo of a negotiation to try to get, again, and the problem is a little bit of an unclear result. So again, the bargaining will begin about what do either of these countries have to show in order to demonstrate that they've come forward with something that would be acceptable in order to get these tariffs lifted.
Eli, let's bring you into the conversation. I mean, as Jennifer indicated, these are huge numbers. These are, direct trading partners. Does that change the calculation for you when you take a look at your investment strategy now?
Yes, absolutely. So look, President Trump is going right for the jugular here. These are the three largest trading partners of the U.S. And I think we have to be really careful on how this is probably going to reset inflation expectations. Now, I think the general consensus for Trump's 2.0 so far is that it's good for equities, it's bad for bonds. And we've seen, bond yields on the long end come up as well. Now, there's a limit to how much bond yields could come up without scattering the equity rally. Now, we think that if inflation expectation starts creeping up, the Fed stops cutting rates. Now, we could see the 10-year move towards 5%, and history shows us that if it goes beyond that, then that starts to be a problem for the equity uptrend that we're seeing. So this is something that we have to be real careful of, Haslinda.
Of course, this is ahead of PCE. It's also ahead of that December move. Expectations are that the Fed may cut 25 basis points. Might this just change the needle for the Fed?
Well, we think that the Fed is probably mostly on autopilot for the next 2 to 3 cuts for now. I mean, they've just started. Real rates are still too high, and Trump hasn't come on yet. So I think they'll do a little bit of wait and see on how the data comes in. But I think, from the last minutes we saw, I think certainly growth is still resilient. They are watching out for how, inflation expectations are moving. And again, if Trump's tariffs moves that needle in the direction that they're not looking for, I think we could see probably higher bond yields start to be a problem for markets.
What we're seeing right now is the reaction in the dollar at the highest level in about 2 years. I mean, how concerning is that?
That is a problem. That is a problem. That is a problem for emerging markets, and that's a problem for Trump too. He wants a weaker dollar. We've heard that, which is why I think the nomination of Scott Bessent as Treasury Secretary is a really, I think, key development yesterday. In fact, I think we saw the dollar weaken on the news of his nomination. We saw bond yields come down as well, and I think he has expertise of how markets work. And I think he's going to be really instrumental in helping Trump get his cake and eat it too, meaning have his tariffs, but yet have markets perform well.
Jennifer, we heard from Eli saying that Trump understands how the markets work. Does Trump understand how tariffs work? Because by imposing tariffs on trading partners, it may come back to bite him in, well, you know where.
I would say many people would argue that he does not, because certainly he kept saying again and again on the campaign trail that it was China that was paying the tariffs or Mexico that was paying the tariffs, when obviously the reality, it is the American importer that is paying the tariffs. So again, the basic cost of all of these tariffs falls on the American importer. And again, just to be clear on the impact on inflation and everything else, with respect to these Mexican and Canadian tariffs, the importers are bringing these in because these are inputs into what we need. Again, they're largely bringing in parts and components and oil and gas. And so when our importers now have to pay a lot more for all of those components, it makes everything that they make using those imports much more expensive. Again, if you flip over to what's going to happen with respect to China, again, they're going to add an additional 10% tariff on top of already all of the existing tariffs. I mean, to me, what's really significant there is what does not right now have an additional tariff coming in from China. It's largely a lot of the kind of retail ready products that are sold at Walmart and Target and all those places. It's electronics, it's computers, it's watches, it's appliances, it's clothes, it's shoes. Those have largely been spared from these extra China tariffs, but now they are going to get hit by this additional 10% tariff. And again, a lot of that I think you're going to see immediately get passed on in terms of increases to consumers for the prices that they're paying for things.
Mm. And by some calculation, U.S. imports would drop 50%, exports slumping 60%. I mean, Trump won the election on the basis of an economy that is, squeezing most of the Americans. I mean, how do you see this playing out in the U.S. economy? How might that impact growth going forward?
So I think it's going to have a very negative impact on growth because, again, a lot of what's being imported are parts and components that you can't just change at the last minute and say, okay, well, never mind. I don't want it from China. I'll buy it from somewhere else, or I don't need this part from Mexico, because those component parts have been, again, engineered and designed and tested and qualified to go into that particular use by that particular American company that is using it to make something else. And they cannot simply immediately turn on a dime and start using product coming in from somewhere else. So it will have a downward pressure on, again, U.S. production. It will have an upward pressure on prices, and overall, again, a downward pressure on economic growth and activity. I mean, we saw this when the Trump tariffs went on initially, 10% on aluminum, 25% on steel, and then ultimately the tariffs on about $360 billion worth of imports from China. Lots and lots of economic studies to look at what was the impact of the tariffs. And the stated goal was to return manufacturing and to return jobs to the United States. And if you looked at it and said, did it do that? The ultimate answer to that question so far has been no. Because those tariffs hurt so many of the downstream users of steel and aluminum that there were job losses there. There was retaliation, again, heavily by China, affecting lots, for example, of agriculture exports. So again, lots of people that had been exporting lost their jobs. So the net effect of the tariffs to date has been a negative one for the U.S. economy. And so I would imagine that with now these idea of increasing the tariffs, particularly on Canada and Mexico, our two largest trading partners, the effect is going to be even more of a negative downward pressure on U.S. economic growth.
And for China, Eli, the effect will also be negative. This is an economy that's just experiencing nascent growth. Yet, when it comes to the markets, you say that you are pretty constructive, China, that you should be overweight.
Right, so that is largely a function of valuations, right? I mean, so much negative news have been priced in. Really, the worst 60% tariffs has been telegraphed in advance. And I do think that the Chinese authorities are much better prepared this time to deal with what's coming. I think,
what's in the toolbox? How can they counter this?
That's interesting because they've done quite a fair bit in terms of the monetary side. They've tried to, do a lot of restructuring in terms of local government financing as well. Now, the last arrow to come will be fiscal, right? And, China has been running on a dual-track economy over the last decade. One is focused on exports. That's going to be in real trouble with Trump's tariffs to come. But the internal economy, the domestic side, now that's struggling right now. And we think that they are probably holding in reserve fiscal policies to boost domestic consumption. And with Trump's tariffs being announced, that's probably in reserve to counteract that when it comes.
So you're looking at a triple R cut soon?
Sure. Yeah, I think, on the monetary side, the easing is going to continue. There's going to probably more to come in terms of clearing the, unsold inventory on the housing side as well. What's really been lacking and inadequate and frankly disappointing so far is the lack of fiscal, especially in terms of, boosting consumption demand. In terms of, I think, what we are seeing in terms of business confidence as well. And that, I think, will come probably in the first half of next year in response to Trump's tariffs internally.
If you're overweight China, what would you be buying right now? When we see a dip in Chinese stocks, what would you be buying?
Right. The strategy here is we think the A shares are probably more domestically focused. It'll be more sheltered against the tariffs. We talked about the domestic track earlier. The large platform internet names are excellent companies. Those are really attractively valued right now. And I think the last prong of our approach is really the quality yield plays that are stable, growing companies that give cash flow. So we think they are still on a bottom-up basis, a lot of attractive opportunities in China.
Okay. Jennifer, before we let you go, what are the prospects of a trade war? An extended trade war?
Yeah, exactly. So just to understand it, I mean, obviously, all of these tariffs break the U.S.'s commitments. I mean, under the USMCA agreement with Canada and Mexico, we committed to charge 0 tariffs on goods that meet these rules of origin, qualifying as these goods. Similarly, we agreed within the WTO system not to charge China any more tariffs than those that were listed in our tariff schedule. So all of this violates the United States' commitments to its trading partners, which means that Canada, Mexico, and China are well within their rights at some level to challenge these U.S. actions and to presumably ultimately to retaliate. That is their sort of legal right to bring these challenges and to think about that. And the issue there is whether that's advisable, because once you start down this tit for tat road, again, then it leads again to a much broader trade war, which has much more negative impacts for the entire world. I mean, certainly if we see the world breaking up into blocks, it will have a hugely negative effect on the world.
And some say it could shave off by 0.5% global growth by 2028. Jennifer, thank you. Jennifer Hillman of the Center on Inclusive Trade and Development. Eli Lee of Bank of Singapore is sticking around. Still ahead this hour, we'll hear more from my interview with Minneapolis Fed President Neel Kashkari, including his views on the Fed's upcoming rate decision, U.S.-China tensions, and of course, the Bitcoin rally. Keep it here with us. This is Bloomberg. Well, welcome back. You're watching Inside. We're tracking U.S. assets. Take a look at how the dollar is rallying right now. The Bloomberg Dollar Index at the highest level in about 2 years on the back of the plan from Trump to impose tariffs, not just on China, but close neighbors, the likes of Mexico as well as Canada. S&P futures pretty much unchanged at this point in time. 10-year yields sitting at 428.29, but it is the move in the dollar that's really gaining attention here in Asia. Of course, emerging market currencies in this part of the world in in particular getting a hit on the back of that strong dollar. Eli Lee, Chief Investment Strategist of Bank of Singapore, is still with us. He believes that Scott Bessent's familiarity with markets is a plus for investors. It is a plus, but right now the focus is on the dollar, expected to remain quite strong on the back of the possibility of those tariffs. I mean, what are the crosses that you're looking at?
Right. So, you know, the strong dollar is going to be a real problem for emerging markets. It has been historically. And, you know, if we do see tariffs coming in, that's going to be a negative for growth, right? Especially within the region. At the same time, the central banks in the region are going to have their hands held in terms of cutting rates to support growth because of the weakening currency versus the dollar. So, I mean, we are seeing this in South Korea, for instance, where growth is weakening, but we think the BOK will have to pause and cut next year because they are worried about the Korean won weakening. And really, if you look at China as well, they've really only started easing intensely after the Fed has cut rates and the dollar started to moderate its strength a little bit. In Japan as well, we've seen how a weak yen could really, you know, cause significant volatility. So I think these are going to be tricky waters to navigate, Haslinda.
So we can expect the currencies in this part of the world to continue to weaken. The won, the Indonesian rupiah, the Thai baht, for instance, right?
Right. So which is why I think the nomination of Scott Bessent is going to be important. Now, Trump wants his cake and eat it too. He wants a weaker dollar. He wants his tariffs. He wants his fiscal spending. He wants markets to perform well, equity markets to perform well. These are going to be this is going to be a narrow needle to thread. And I think Scott has, you know, knowledge of how markets work. It's good to have somebody in the cabinet to advise them on how to navigate these waters.
Safe haven. Where do you find protection in times like these, bearing in mind that, you know, there's so much uncertainty when it comes to Trump? I mean, we're talking about how we're going to be headline driven from here.
Absolutely. Now, ironically, I think the US dollar is going to be a good safe haven. That's still going to be, I think.
And he wants that.
The haven
right?
of choice. Absolutely.
Yes.
Gold is probably going to do fairly well over the next 2 to 5 years ahead. Central bank buying is still strong. And finally, we think US equities will likely perform well.
Yeah, I mean, you got to wonder as well, you know, when it comes to the markets in this part of the world, which are the ones that show a lot of potential? You know, we talk about how China may be under pressure. Are there, you know, certain markets which may be able to withstand, you know, the uncertainty?
I think it's going to be a tricky time in terms of the fundamental growth outlook for economies in the region. It's a different story for asset prices, though, because it depends on what has been priced in by the markets. Now, for China, which you talked about, I think it's interesting because so much negativity has been priced in that we are seeing asset prices at historical lows, right, decade lows. So I think, you know, the saying, buy on rumor and sell on news, right? And that's going to be the reverse for China, we think. And if I think Trump eventually shows us his cuts, how much tariffs is going to be on the table for China, we could see, I think, that reduction of uncertainty potentially be a positive catalyst.
You know, it's funny, right? We're seeing how there was so much confidence, there was euphoria in the market, yet sentiment was pretty fragile. All it took was one headline to send investors scrambling. In this scenario where, you know, there are expectations of further tariffs on China, is India now back in play?
Absolutely. India has been in play. It's going to come back in play. It's going to continue to be in play.
But we saw an outflow of money from India to China.
Right. I think there's going to be a little bit of ebb and flow. But, you know, one statistic that always struck me is that the manufacturing output of China is 10 times that of India. It's going to take decades, a long time, you know, for the rewiring of supply chains to happen. And that's going to mean that India is going to continue to benefit over the next few years, for sure, that reallocation of capital towards India. And I think that means that Indian equities will perform well.
But elevations, when it comes to valuations, they're pretty elevated. Do you wait for a correction before getting into India?
Well, we'll prefer to stay invested. I mean, we've been in, you know, overweight on India for some time now. That trade has worked well. I think what's going to be driving the Indian market going forward is probably going to be earnings growth, which we think still enjoys a fairly healthy outlook, and policy continuity. In India is going to be a huge plus as well.
Yeah. When it comes to foreign investor sentiment in India, might that be impacted by what we've seen, with the Adani case, the Adani Group And Governor Adani himself is getting indicted by the U.S. I mean, might that impact sentiment? Foreign funds?
All right. I'm not a legal expert. I think, we're probably going to see how the dust settles on that one. But over the near term, there's going to be some volatility from that for sure, given the size of the group. It could be a buying opportunity. But again, I think we'll have to see how things develop from here.
Are there sectors that are worth looking at in India right now?
Sure. We like the tech sector. We like the consumer sector as well. We think the healthcare sector looks fairly interesting as well. And also overlaying all of this is the potential for AI to really boost earnings over the long term for these sectors. And we think India provides an excellent opportunity for investors looking for exposure to these areas.
Eli, before we let you go, as we inch closer to 2025, what's the biggest risk out there? Is it geopolitics? Is it Fed? Is it Trump? What is it?
You're not going to like my answer, but it's going to be all of the above. And I think it's really interesting because it's really how these factors converge to form a really volatile environment, which is going to be, good for investors eventually. That means if you have a nimble approach, you're probably going to do well.
Well, you have to have a nimble approach because Trump is going to be in power. Eli, thank you. Eli Lee of Bank of Singapore. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Debate over a potential U.S. rate cut in December is ramping up as investors look ahead to the latest reading on Wednesday of the Fed's preferred price gauge. Minneapolis Fed President Neel Kashkari told us what key factors he's watching out for as officials prepare for their final policy call of the year.
Right now, we know that inflation is somewhat above our target. It's running at around a 2.5%, 2.6% run rate right now. I have some confidence that it's gently trending down. And right now, the labor market remains strong. The question in my mind, the biggest question is, where is the neutral rate environment? We've had relatively high interest rates relative to the prior 10 years. And the U.S. economy has continued to grow with great resilience, and the labor market has been resilient. And so how do I reconcile the fact that the policy rate has been relatively high and growth has been sustained? That suggests to me that perhaps the neutral rate environment is higher than it was in the past, and that perhaps monetary policy is not putting as much downward pressure on the economy as I would have expected. And so this is what I'm trying to understand right now, is how much downward pressure are we putting on the economy, and what is the path for inflation? But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Why not pause? You talked about how resilient the economy is. You talk about how resilient the labor force is. You talk about how resilient all the factors are. And add to that, we have, this rally in the stock market. Why not just pause?
Well, you're making good points that would argue in favor of not cutting rates. On the other hand, if I look at the underlying components of inflation, goods inflation has fallen all the way back down to pre-pandemic levels. Services inflation is trending down, and that's tied to wage growth, and wage growth is slowly trending down. And what's left is housing inflation. Housing inflation is still high, but if we look at forward leading indicators of where housing inflation is likely going, and that's the inflation of new rents, that new rental inflation has already come back down. So that suggests that housing inflation ought to come back down. Ultimately, we want to get inflation back down to our 2% target. We're not aiming to undershoot it. And so we do have to make some judgments about what is the path ahead for inflation. And that's going to be an important determinant on what we do with monetary policy.
We also asked how Trump's tariff threats could affect global trade and his views on Beijing's battle to revive its economy.
There's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? Reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to, but I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
And that was Minneapolis Fed President Neel Kashkari. Well, counting down to the India Open, it should be open in about 30 minutes from here. Let's do a check on how those stocks are shaping up. Bear in mind that China is under pressure from the threat of those Trump tariffs. People are now saying that money could be flowing out of China into India. Might we see that again? Bear in mind as well that valuations are pretty extended and investors will have to decide if it is good enough. And we know that retail investors have been propping up Indian stocks, including Adani shares. Adani back in focus, of course. There are concerns about its legal troubles worsening on the back of that. The Sensex in the early minutes currently in positive territory, up about 0.3%, breaking away from the rest of Asia, mostly in negative territory on the back of the threat of Trump tariffs. And this is how it's looking for the Adani Group shares. Adani Enterprises in a negative, down about 0.1%. Adani Green is the one that has been front and center, reversed those losses yesterday. Today, back in losses, down about 1% in the early minutes. Total holds of Adani investments awaiting clarity on those U.S. charges. Now, while markets digest the latest developments on Adani, there's been comparative silence from Prime Minister Narendra Modi's allies over the allegations, a sign of perhaps the strong political support Gautam Adani still enjoys in India. Let's dig deeper into the local political dynamics with Bloomberg South Asia economy editor Ruchi Bhatia. Ruchi, the U.S. indictment of Adani is making waves across the globe, but how are things at home? What's the mood? How are Modi's allies taking it?
Well, the Indian opposition party, Haslinda, that is led by the Indian National Congress, is making a furor and are demanding a parliamentary probe into the U.S. indictment. On the other hand, the allies to Modi's Bharatiya Janata Party have remained silent, and this perhaps shows the kind of support across party lines that Gautam Adani and his, group companies really have in India. And this is partly on account of the kind of response that we have seen after this U.S. indictment, where Modi's two big allies, that is the Telugu Desam parties, N. Chandrababu Naidu, as well as the Janata Dal United of Bihar, they have refrained from commenting on the issue, so much so that one of the parties just said that they are looking into the issue and will act only in due time. Having said that, one thing is very clear, that it is hard to initiate any probe here in India. In fact, we saw how even the Indian regulator did not close its report. They acted on only 23 out of the 24 charges that they were looking into. Besides that, the Adani Group also has its investments in the non-BJP states as well, and that is something that will make it very, very hard for India to initiate any kind of a probe with respect to this US indictment. Also remember, the port to energy conglomerate is extremely intertwined with the kind of ambition that Prime Minister Narendra Modi really has for the Indian economy. India has, remember, doubled down on infrastructure spending in the last couple of years, and there is a lot of talk about how private sector should be getting into the infrastructure space, and the Adani Group is very central to the ambition that Prime Minister Modi also has. So it will be very hard to initiate any probe, as I said, and the allies have largely refrained from really getting into this issue as of now.
We've been talking about how this company has a global footprint, its global portfolio likely to come under scrutiny. What does it mean for the company's projects?
Well, it will mean that the Adani Group in the long run will find it difficult to execute some of the projects that are there in different countries. For example, you did hear from Total Energies where they said that they will not be making any new financial commitments. On the other hand, from Kenya, there was a cancellation of their contract as far as the airport and power transmission lines are concerned as well. Adani, remember, had already been facing troubles in Sri Lanka and in Bangladesh, and that would mean that some of their global projects may go slow. They could also have troubles with respect to raising fresh money, and of course, a lot of countries would be waiting to get some clarity on this US indictment, which would mean more disclosures for them going forward. So there is a big cloud, there is a big overhang that's there on the Adani Group, not just in some of the other countries, but back home as well. They have projects in some of the Indian states as well. So how that really plays out is something that we will have to see over the next few days.
Ruchi, earlier I spoke with Minneapolis Fed President Neel Kashkari. Here's what he had to say about the charges.
Ultimately, I think that it's sending a warning message to businesses all around the world that you need to honor these laws, and bribery is not acceptable in the United States or in your home country if you're going to be raising money from American investors. And so, what the implications are going to be in India and the Indian business community, I don't know at this point, but it's something I think businesses all around the world must be paying close attention to.
And of course, my conversation just earlier with Ruchi Bhatia out of India. If you're wondering why your cup of joe is getting more expensive, it's because coffee prices have surged to the highest in almost 30 years. Avril Hong is here to tell us why. I mean, this has become a luxury item.
Yeah, because it's so expensive, right? And, just thinking about how your coffee just every day in the morning, a necessity, is just getting more expensive. But to answer the point about why we're actually seeing this, it's weather related. We're seeing in the top suppliers such as Vietnam and Brazil bad weather, and they're seeing really dry conditions for much of this year, particularly acute, the condition in Brazil and some of the key agricultural areas where we're actually seeing the worst conditions, drought, in about 40 years. So that's affecting the prices of coffee. You said earlier how, these coffee futures, they've just jumped to the highest level since 1997. That's on Arabica, which is seen as the more expensive variety, but it's also having knock-on effects on Robusta, which is the budget-friendly variety. So that's also experiencing some upward pressure, and coffee just getting more expensive.
We talk about how coffee is expensive. One of the most expensive coffees out there is actually in this part of the world, in Indonesia, coffee luwak. I mean, some say that it can cost anything between $20 to $100 per cup. I mean, that's really expensive. And from the sound of it, coffee prices are going nowhere except higher.
Yeah, I mean, civet cat coffee, I think, is quite a niche kind of product. Might not be for everyone, given the way that it's kind of grown. But, you know, coffee is getting more expensive, and we're seeing money managers actually betting, adding on to their long positions on both Arabica as well as Robusta, based on the most recently available data. And the sense you get is that it's just going to keep climbing. If you look at Brazil, for example, there's no rain forecast in some of these key growing areas for at least the next 2 weeks. You think about how farmers, they have a lot of pricing power. They have strong financial positions. So you get the sense that they're going to just be able to keep charging higher prices. And the issue is not just confined to just Vietnam or Brazil. We're seeing Indonesia, to your point, also facing some bad weather last year, and that's affected their crops this year. And the US government forecasts have actually revised downwards the production they're expecting from Indonesia. So all these factors just potentially driving coffee prices higher.
I'm putting it out there. I am a coffee drinker, and
As
I
am
think, yeah, that's right. And
we live on coffee.
Exactly. When you start at 4 a.m, you would live on coffee. The thing is, customers like us will get squeezed. I mean, you know, we talked about how in Australia people can afford, the younger people can afford avocados. Now they won't be able to afford coffee. So what's that to live on?
Yeah, it's a millennial endeavor, right? Avocados. But we are seeing how when it comes to the coffee prices, is not just something that the consumers are experiencing, the roasters are also feeling the pinch, right? And even though I think overall you see in food wholesale prices, they've come down since the peaks that we saw in 2022, I think this speaks to how we're still seeing some of these key agricultural products prices are still elevated, and that's being reflected across the supply chain. Sellers are cutting discounts, they're able to raise prices, they're warning of more to come, and I think this coffee issue also speaks to how there's a bit of reliance on the world, on Brazil, not just for coffee, but also soy, sugar. So it looks like, this could be tricky for a while to come.
But you know what? I'm going to bet that demand for coffee is going to keep getting higher when Trump comes back to power because of the unpredictability.
We're going to need it a lot more, probably. Yeah.
When you're headline driven and you need to stay awake and people, trade on headlines, well, you're going to need your coffee. April Hong, thank you so much for that. Now, before we go, let's take a quick look at how Adani stocks are doing. Of course, that's on the back of how the expectations that the legal liabilities may just pile up from here. Taking a look where we are in the first few minutes of trade for the Adani Group shares, Adani Enterprises in positive territory, currently up by about 1/10%. Adani Power also in the positive, but it's not the same for the Adani Green Energy stock, currently down by more than 2%. Of course, people have been talking about how its legal troubles may worsen. Investors' lawsuits are likely to pile up. And before we go, we'll look ahead to Insight tomorrow. We'll have Bloomberg Group President Commissioner Noni Purnomo joining us exclusively to discuss opportunities in Indonesia's taxi and ride-hailing space. Plus, JP Morgan Asset Management's Raisa Rashid will be joining us for the latest on markets. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.